to the IP Matters webcast series by Contextual. Today we're joined by Efrat Kaznik to present a webinar on IP valuation and understanding the financial value of IP assets. We're very, very lucky to have Efrat with us today. She's an intellectual property valuation and strategy expert with over 20 years of consulting experience, focusing on assisting clients with the management and monetization of their IP and technologies. She's the president of the Foresight Valuation Group and a lecturer on IP management at the Stanford Graduate School of Business. Efrat is also listed on the IAM 300 list of leading IP strategies for 2013, 2014, and 2015. So since I know you're looking forward to her, I will switch over to Efrat Kaznik and let her get started.
Thank you very much, Zoe. Hello, everyone. Here from Palo Alto. It's a nice day here. Hopefully it's a nice day where you are. Today, I just wanted to thank both Pedram and Zoe for inviting me to speak on the ever-popular topic of IP valuation. I'm going to switch straight to the presentation. I'm sharing my screen here. Just a second. Okay, and I hope you can all see that. The topic of IP valuation is the topic of that I've been working on and with over the last 20 years. As you can see from my bio here, which you have a full copy of in the webinar page. I've been working in this area for about 20 years, doing a lot of valuation for different organizations of all sizes, all industries. The other part of my career I've spent as an entrepreneur and a startup advisor. So these are the two areas that we spend a lot of time on here at Foresight. We provide IP consulting and valuation, and we also do a lot of startup advisory. And we're actually also trying to bring the two of these together, which is somewhat of a challenge sometimes. And as we go through the presentation today, we'll touch on some of the circumstances where startups and IP intersect. The outline for today, we have a short presentation today, so I'm going to try and keep it to a high level and really focus on the business circumstances of why, when, and what IP valuation is, how it's done, when is it done, why do we need it in a business circumstance. And the focus here is really on situation where you have to put a dollar value on IP. And that's very different from all sorts of assessment that people are doing on IP portfolios. The dollar value situation is very unique. It doesn't happen a lot. We're going to explain exactly what are some of the challenges with that. Why is it so challenging? When do we need to value IP? How is the context very important to that? And how do we actually value it? And I'll hopefully have time for a couple of case studies and a few key takeaways. So hopefully you enjoy that today. I'm going to start with what we call the IP valuation gap. So like every good startup presentation, we work with a lot of startups here in Silicon Valley, and we work on a lot of slide pitch decks on our other side of the business, and we always tell people you should start with a problem. So in order for me to convince you that you need to sit through the next 15 minutes with me today, I want to jump right into the problem. There's an IP valuation gap, and anybody who's been involved with IP knows bits and pieces of that, but I try in this slide to kind of capture the problem. And the problem has three components. The first component is that your internally grown IP assets as an IP corporate holder. So if you're a company investing in R&D, developing technology and patenting or getting other type of IP protection on that, those assets are not actually reported anywhere in your financial statements. Now that usually comes as a shock to people, and you don't have to know much accounting to understand that there's a balance sheet and there's ways for companies to report their assets. IP, internally grown assets, are actually not reported. So that's the beginning of the problem. So there's nowhere to look for them. They only get reported when you buy them. So you buy them, usually you buy them through buying a company. That's an M&A situation. The second component of the IP valuation gap has to do with the fact that not only are the assets not reported, but the transactions are not reported either. So there is a huge gap in transparency into the circumstances and the key factors that participate in a deal. So what is the price? What is the royalty rate? These things are usually not reported because companies don't have to report them. The third component of the IP valuation gap is the fact that IP assets are unique. So even if you had the data, it would be very difficult to compare one asset to another. I want to go quickly into IP valuation methods. I'm not going to spend a lot of time today going over methods. In my mind, the problem doesn't lie with the methods. The problem lies with understanding the circumstances and the lack of data. But I am going to touch a little bit on IP valuation methods so we have a basis for conversation into some of the examples that I'm going to show later on in the talk. Like any other asset, IP valuation assets are borrowed from the world of tangible valuation assets. And literally, we always speak about three valuation methodologies. One is market. Market is the valuation method that looks at comparable transactions. It's the most desirable. The market method, the income method, is the one that we most commonly use, and that's the one that the last methodology that is available to us in an IP valuation scenario is the cost method, and that one is usually not highly recommended, specifically due to the fact that there's no measure of utility or demand. So the problem with the cost method is it's looking at the cost to create an asset without really looking at any sort of demand for that asset. I want to move forward to what are the circumstances when IP assets are being valued. Usually we get people calling us in all the time, and it seems like there's a lot of circumstances when people need help with IP valuation. But generally speaking, a lot of these circumstances fall into kind of similar buckets that you see across the board with bigger companies or smaller companies. So as you can see, there's a couple of colors here. Some of them are darker, some of them are lighter. I've separated some of these in a separate bucket from the others. And as I've been mentioning, valuing IP, since we started out with the IP valuation gap, part of the problem is the fact that IP valuation is not done on a regular basis. So it's not an everyday occurrence. So usually when people call with an IP valuation need, our first question is, why do you need to do that? So here you can see, in this slide, you can see the valuation circumstances that I highlighted in different colors, what we call reporting or compliance. There's a situation where it's mandatory to value your IP. So that would be IP in tax reporting, financial reporting, or what I also call damages in litigation is another situation where it's kind of a mandatory occurrence. But most of the IP assets, you can look at the size of the bigger bubble, are not being valued ever. So they're not being valued, and so that's part of the problem that we have with the IP valuation gap. Now, another thing is the what of the IP valuation. So what is really important to remember is not only there's an IP valuation gap, but there's also a context that really is really important with IP valuation. And the context depends on who the IP holder is, what is the IP type, what is the transaction that we're looking at, and what is the purpose. So if you're a university with patents who wants to sell for enforcement, just as an example, that would be an entirely different value as to if you're an operating company that has technology that you're looking to spin off into a startup. And it's really important to understand these circumstances in order for us to really understand how we approach IP valuation. So how do we value IP assets? So when we value IP assets, we really, keeping the context in mind and the methodologies in mind, we usually go through three steps. We look at what is the valuation purpose, as we discussed. There could be multiple purposes. Then we do some sort of an assessment of the assets. And it's usually a combination of three disciplines. It can be a technology assessment, it can be a legal assessment, or it can be a business assessment. And then the question is, what is the valuation scenario? And the valuation scenario is really important because this is what determines how you run the valuation. Some of the case studies that I wanted to discuss today, keeping in mind the fact that there's a purpose, there's an assessment, and there's leading to a valuation scenario. So I wanted to give a few examples of IP valuation circumstances that arise and how we treat them in that framework. And then I have one case study that I would like to discuss. For example, a client called the other day. They are a startup and they wanted to value their IP for putting it in the books, for putting it on their balance sheet. So the purpose is external reporting. Now, as we know, from the first slide, that is not really an option. So in that case, that's a situation we can do nothing about. So we can't really, there's no point even in assessing the assets or in determining the scenarios. This is a non-starter from the beginning. So the valuation purpose is very important. Another example of a valuation purpose is another startup that called in. This is a startup that is quite advanced and has spent a lot of money on patenting IP. And there is a need internally to explain to the board and to management what is the value of the IP portfolio that has been created. In a situation like that, this is what we refer to as internal reporting. In a situation like that, we can obviously help out. We would need to understand what is important for management. We would go through an assessment of what's been patented, and we would tie it up with the vision and objectives of the startup. And a lot of times, too, that relates to a potential M&A transaction. So that's another case that we're dealing with now. Is there's a startup that needs to is looking into selling the company, is very valuable IP. So that's the purpose. Here, the valuation gap is really important because there's no way of telling what the value of the IP is, and so the company is looking for us to actually bridge the valuation gap between what the buyer is looking at in terms of their projections and the value of the IP asset that is very critical to them, especially as a startup. So these are some examples of valuation scenarios, and I would like to actually conclude with one case study. We're on a slide that shows a case study. So the case study that I want to present today has to do with a patent acquisition in litigation. And here's the scenario. So we have two companies, actually three companies. Company A is a large market leader in the LED market, lights. Company B is a Chinese manufacturer entering the US market with some cheap LED light bulbs, and there's also and is being sued by Company A. Company C is a holder of IP that has some patents that Company B could use in order to countersue Company A. So I know that's kind of complicated looking at bullets, so I have a graphical depiction of that. So the situation is here. The situation is such that Company A is suing Company B. Company B has no patents, reaching out to Company C. Company C was our client. So Company C is reaching out to you and asking you, what's the value of the patent? Now, this is a very complicated question in this situation because there's a value to whom question. So in Company C's hands, those patents were sitting on the shelf and had no value whatsoever to them. It was part of a non-core business for them. However, that patent is very valuable for company B. So there's a value to company B, and the value to company B is the litigation avoidance. So there's the whole calculation that one can run as to how is company B better off having that patent. There's also the value to company A. So the question is, what should company C do? They can sell the patent to company B. They can also sell the patent to company A. They can also do other things with the patent, and each of these situations has a different value. So that's when there's a whole strategy around the IP valuation. The IP valuation is actually serving the IP strategy in trying to optimize the value of this patent to whoever is trying to monetize it. So here on this slide, I just summarize. This is a case study that we teach. I teach at my Stanford MBA class. You know, every year that we do that, we get a lot of different options and opinions. But these are kind of some of the key strategies that we could think about in terms of how to look at the value of this patent. So I would like to conclude this what has been a rocky presentation with some key takeaways, and then hopefully we have some time for some questions. And if not, you can always email me the questions. So if there's two things that we've learned today is A, there's an IP valuation gap. It's real and it's there, and it's not going away because accounting rules are not changing and reporting requirements are not changing. So whatever you think you've heard about it, it's there to stay. Takeaway number two is the IP valuation is highly contextual. Depends on who holds the IP, what is the IP type, what transaction we're talking about, and what is the purpose of the valuation. And that is the end of my talk, and I'm heading it over back to you, Zoe.
Thank you so much, Efrat. I really appreciate the presentation. I know I personally learned a lot. I think everybody else did as well. So what we'll be doing from here is posting the presentation for you recorded on our website so that anyone who missed it can take a look. And we want to really thank you again. Make sure you tune in for our next webinar. It will be Thursday, September 10th at the same time, 10:30 a.m. Pacific, and that will be on IP for small and medium enterprises. So thank you again, and have a great day.
Thank you.